Welcome to the show. I'm Michael Johnston. Joining me today to talk about tax efficient investing is Kelley Long. Kelley is a certified financial planner and a CPA. She is the founder of Financial Bliss with Kelley Long, a money coaching firm and podcast. Kelley, thanks for coming on today.
Thanks so much for having me, Michael. I'm really excited to geek out about underutilized strategy.
Absolutely. We're a couple of nerds here going to talk about some nerdy tax saving strategies that will save people money. So I think they'll be excited to hear about it. So we're going to dive pretty deep today, Kelley, into the Mega Backdoor Roth, which has an awesome name, by the way. I don't know who came up with it, but I should hire them to do some branding work for me. But let's start at a high level. Give us the elevator pitch or kind of the executive summary of what we're going to be talking about today.
Sure. So the Mega Backdoor Roth is a retirement savings strategy that basically exploits a lesser known rule that technically allows much larger contributions to a 401k than the well-known annual, what we call elective contribution limits, through what's called a very technical term, after-tax contributions.
Got it. So I think it's kind of always helpful to talk before we get too into the weeds, and we're going to walk through how someone does this, but why is this a potentially valuable tax strategy? So I kind of like to think of this as like, well, if you're not doing this, what's your alternative? Where's this money going if you're not going to do it in a Mega Backdoor Roth?
So the most valuable thing is that it just allows people who have access to the tools necessary, because there are some kind of specific circumstances needed, to put more money away in a tax advantaged way for retirement than they would just through your typical 401k and IRA or SEP IRA limits. So generally, this is money that you would otherwise be investing in a taxable brokerage account.
Got it. And that's suboptimal for a lot of reasons, one of which you're going to have like the tax drag each year. If you have dividends, those are going to be taxed. If you're doing a rebalance and you're having a capital gain, if you're selling for other reasons, you're going to have capital gains taxes that you're going to owe in a taxable brokerage account. And it might not sound like a lot, but that tax drag can be, if it's a few basis points or even a percentage point, especially for younger folks who have a long-term time horizon, that can kind of add up. And then the brokerage account, it's not great in retirement either. When you go to sell to fund your retirement, whatever it is, you're going to pay capital gains taxes. It's ultimately got to become cash if you want to use it. So you're going to pay taxes there. So brokerage accounts there's some flexibility. There's some good things about them, but they're kind of suboptimal for a lot of reasons. Okay. So who can do this? And I guess equally important, like who should do this?
Well, in my opinion, anybody who has the tools available should do this. And probably the biggest limitation would be cash flow. So otherwise, if you have the very specific circumstances, which I'll list here in a second, then it makes so much sense. If otherwise that money is just going to either languish in a savings account or just going into the market through taxable brokerage, because you're essentially doing the same strategy, but without the tax consequences. So the first thing, and probably the biggest limitation, is that you have to be eligible to contribute to a current 401k or 403b plan. And that plan has to have the following options. So it has to allow Roth contributions, which statistically is more and more common to see. So if you have a job with a 401k, most likely you are able to elect Roth contributions. But you also have to have what's called after-tax contributions available, which I'll define here in a second.
Okay.
And then in addition to that, you either have to have the ability to do what's called in-plan conversion. So the ability to take your pre-tax contributions or employer matching dollars and convert them to Roth within the 401k or 403b plan, or your plan, highly unlikely, has to allow you to take that money and roll it into a Roth IRA while you're still working. So all of that said, if you have all of those things, let's take a step back and let's talk about what those after-tax contributions are, because that's confusing in a lot of workplaces that I see. So prior to going out on my own and starting my coaching firm, I worked for a workplace financial wellness company. And part of that job was intimate knowledge of 25 or more larger employers' 401k plans, which sounds really boring, but it was really fun to learn all the different ways we all kind of as a general population know that, you can put up to $22,500 into a 401k unless you're over 50. And then you've got that catch up contribution, but there's so many little nuances. And
Sure.
what I saw was, and internally companies refer to these plans in different ways, especially companies that happen to have these specific strategies available, because usually their plans involved some other type of maybe cash pension plan in addition to the 401k. But a lot of companies will call their Roth contributions after tax, because in the employee's mind, or in the way it comes out of your paycheck, is after the taxes are assessed. But after tax contributions are actually a technical IRS term as well. And what's most important to know here is that we are all familiar with those kind of elective contribution limits, but there's a larger limit that the IRS places on total contributions. That would be yours as the employee and the company's contributions. And what the after-tax contributions does is allows you to kind of fill that bucket if there's any gap between what you can put in by IRS statute and what your employer is putting in through matching or profit sharing.
Got it.
That pot of money has different tax treatment than either pre-tax or Roth. So it's more of a hybrid, kind of like an after-tax or a non-deductible IRA contribution. So the funds go into the 401k or 403b. They're not a deduction from your income at the time made. That means when you withdraw them, those would be tax-free withdrawals, but the growth is only tax deferred. So the total limit for 2023, by the way, for this is $66,000 unless you're 50 or older, and then you get to tack on that catch up. So it's what is it? 73,500.
73.5, I think. Okay, so a lot of people are hearing this and they're saying, "Wait, 66,000?
Yeah,
I thought it was 22,500."
Yeah, or 30,000 if you're 50. Yeah,
or 30. Yeah, if you're over 50, you get an extra 7,500 catch up. But we'll stick with to keep it simple here. We'll stick with the under 50 example. So you just said that the limit is 66,000. I think a lot of people are hearing this and saying, "What is she talking about? It's 22,500. That's the most that I'm able to put into to my 401k." What's the gap there? What's the delta?
So that's what we would call the after tax bucket. And so let's just use an example. So let's say you're making $200,000.
Okay.
And you're putting in your maximum. So you put in 22.5 and your employer has a 6% match, kind of the standard. Yeah. And so obviously if you're putting in 22.5, that's 6% or more. So your employer is going to put in their 6% of 200,000, which is only $12,000. So you're actually only putting in 34,500 between all sources into your IRS. But the IRS, according to the limits, IRS says, well, actually, like there's room. There's another $31,500 that's kind of being left on the table. And most companies recognize that, like, their employees, if they're putting the maximum in, that's probably a big stretch. But in especially like consulting firm jobs or smaller businesses, the employer has the ability to say, actually, no, if you want to, as the employee, like plug that gap, have at it. Just know that it has different tax treatment. So where I've seen it is, either when you log in to set your contribution limits, there's often, pre-tax, Roth, or after-tax contributions, so you can actually like divide it up. Now, if you're not maxing out the 22.5, then this doesn't make sense.
Right.
But if you're there, you can elect some of that to go into after-tax. As you'll understand in a minute, the frustration or the challenge can be is if you're doing, regular paycheck contributions into after-tax bucket, that can lead to some unintended and undesirable tax consequences that you could avoid. If, in the case of every plan that I saw that allowed these, usually at the end of the year, the company will allow some type of true up or big contribution, either through bonus, or in one case, you could write a personal check. Who has those anymore? Well, I do. So, and so, because oftentimes, particularly if you have fluctuating income or bonus or changes in compensation, you might not know exactly what your matching dollars are. So if you want to get exactly to that 66,000, you're going to have to wait until after your last paycheck to know exactly what that gap is between your contributions, the employer match, and the total limit.
Yeah.
That's why it's so rare, because it's an administrative hassle.
Yeah. Okay. So let's keep going with this example and kind of walk through step by step. So we'll use me as this hypothetical under 50 employee. I've set aside my 22,500 in my elective deferrals. My employer is relatively generous. They've got a 6% match, so they've kicked in another $12,000. So I'm up to 34,500, which, as you pointed out, I've still got another 31,500 to go before I hit this IRS limit of 66,000. By the way, Kelley, I think these are all the numbers for 2023. They'll change each year. Is that right?
Yes. Yeah. In general, they tend to change every year.
Okay. Got it. So if you're watching this in 2024, the numbers may have gone up. Okay. So I've got this 31,500. So how do I get the most bang for my buck here? Assuming that that my company offers some of the options that you went through, and we'll summarize those again at the end. But what do I do here to make sure that I get this into my Roth bucket?
So however you get that additional 31,500 in there, obviously prior to December 31st of it would be 2023. If it's 2024, the numbers are going to be different because they always go up.
Yep.
Then as soon as you see that money reflected, you log into your 401k or 403b and you see that money in the after-tax bucket, you want to go in and enter a request to convert that to the Roth.
Mm-hmm.
And ideally, so in some cases, some companies have allow employees to set different investment mixes according to the bucket. So you might choose more aggressive investments for your Roth money, because you know that money's never going to be taxed. You might choose bonds for your pre-tax money if you're going to get really specific with your asset allocation. And so if that's the case, then you would want to set your after-tax bucket, if your intention is to do the Mega Backdoor Roth strategy, to cash.
Yeah.
Because if there's even where I've seen problems, where I've talked to people about this, is like they've been putting money into after-tax for maybe years, and that money has grown, which is cool. Yeah. If they do nothing, it's important. So I know I'm getting a little ahead of myself here, but I want to state this because there is a kind of a downside to doing this.
Yeah.
If you leave it in after tax, classified as after tax, one of the interesting things about it is you can withdraw that money from the 401k for any reason before you're 59 and a half. So one of the things,
some flexibility.
Yes. In 401k money generally does not have a lot of flexibility. Once it's in there, it's like you have to have a major IRS defined life event to make an early withdrawal. Whereas like IRAs, you can take that money out to build a roof. You're just going to pay penalties. 401k, you wouldn't be able to do that. But the after-tax bucket, you can do that as long as it's classified as after-tax. And again, your contributions, just like a Roth IRA, wouldn't be taxable to pull them back out, but any growth would proportionately be penalized and taxed as an early withdrawal. But when you make that conversion to Roth, you're basically saying, I'm electing to treat this like 401k Roth money, which then subjects it to all of the early withdrawal exceptions as long as you're employed at that job.
Got it. So you're getting much more favorable tax treatment, which we'll get back to in just a minute. But I think it's a good point you make. There is a downside here. You've got to have, and this is kind of your first point when I said, well, who should do this? You kind of said, well, you've got to have the cash flow. You've got to have patient capital. It's got to be able to sit. What is it? Age 59 and a half, or depending on your age and your situation, you could be tying this money up for a long time. So it's got to be patient capital.
Yes. So in some cases, I see people who are maybe stretching a little bit to maximize this. They're like, okay, my bonus is supposed to be 50K. And I was counting on some of that for whatever. And, but I'm going to stretch and I'm going to do that 31.5. And I just try to make it clear, that money is, you're basically saying, see when I'm 60, right? Like, as long as you're okay with that, if you do this strategy, if you wait on it, this is the other kind of downside or people who need to think twice about it from a cash flow perspective. If you wait and there's growth, then you do the conversion, you can still do it. You'll just have a tax consequence in addition to, just not having the deduction from your paycheck. So any growth would be taxed to you that you're as if it had been a regular Roth conversion. And so you need cash obviously to pay the taxes.
Yeah. We never like those two words together, tax consequences.
I know,
that's
right?
never good news.
I mean, I guess it means you made money, but
yeah, that's true. That's true. So going back to this example where I've got my 31,500 that I put in there, I've been able to do what you said, which is I just leave it in cash. I log in at maybe it's a day later, a couple of days later, I see that I'm able to convert that to Roth. A lot of times a Roth conversion will be taxable, but if I understand it correctly, this is a non-taxable event because it's after tax dollars. I've kind of already paid the taxes on this. Is that right?
That's correct. And so this is where I've gotten into internet arguments with strangers. And it really depends on the plan sponsor and the administrator of the 401k and how they report things. But from a tax preparation perspective, sometimes tax preparers can mess this up because you'll get a form from the 401k administrator saying that you did this and it was a taxable amount to be determined. So let's say you take that 31,500 and you convert it over, you'll get a 1099-R saying you had a $31,500 possibly taxable transaction. And if your tax preparer doesn't know that you were doing this, they're likely to think this was just a regular old Roth conversion, and they're going to put that 31,500 on your tax return. So then you're going to pay taxes on it twice, which completely wipes out the benefit of this. Right. But then there is also the possibility that, and I'm not a tax preparer, so this is where I have to kind of issue my little caveat. Yeah, I'm not totally sure that the conversion could be proportional to your total balance.
Got it.
Kind of more like when you're doing the account aggregation rules, when you're doing a backdoor Roth, if you have pre-tax IRA assets, it's, the cream in the coffee example where you can't separate out that $1,6,500 deposit. You have to actually do it as a percentage of your total.
That's right. I think I've heard that called the pro rata rule. I don't know what the official term for it is, but you can't pick the dollars that you're going to convert over and say, I just want to roll these over. You've got to do effectively a portion of your entire portfolio. Okay, so we've kind of gotten through the end of this hypothetical example where you roll it over and now it's in a Roth account, and that's fantastic because you mentioned earlier, this was after tax dollars, so you wouldn't have had to pay taxes on withdrawal of that, but you would have had to pay taxes on the growth. And hopefully you've got a long time until retirement, and hopefully you're going to have a lot of growth of your portfolio. Hopefully the value goes up and up and up, and the beauty of compounding returns kicks in. And now, in addition to having that contribution be tax-free, all of the growth of it is going to be tax-free as well.
Yes.
Is that right? Yeah,
that's true. I should also mention that if you are within 5 years of being 59 and a half, and this is your first time adding assets to Roth, there's that 5-year rule for qualified distributions. Typically, someone who's engaged in this strategy has been making Roth contributions for years anyway. But I think, the big headline here is if you are making your contributions Roth and you do this after-tax contribution, and your employer, now new part of the Secure Act, Secure 2.0 also was the ability for the employers to let you elect their contributions to be Roth. Right. And that's totally up to each company. So you may or may not have that available. But there is a possibility that you could put $66,000 into Roth just through your 401k. So really doing the math, $72,500 if you're doing a backdoor Roth IRA outside as well in 1 year. So that is where the mega part comes. And most of that money is going through the back door because it's more than kind of our traditional limits. Yeah.
And, to make it even more mega, this is per person, right? So if my wife and I could both do this, and it can be done each year, right? You can come back and do the exact same thing next year, as long as I understand that it's been on, I guess I described it as being on the chopping block. It hasn't been chopped, but it's kind of been talked about. Is there potential that this goes away?
Yes. So the biggest risk to this is that the ability to do it in the future would go away if the law that keeps popping up in different budget proposals from the White House, eliminating or adding income limits for all Roth conversions ever goes through. So that would prevent future uses of the strategy. And then there's always that greater possibility, because there's always that person who wants to remind me that, any law could change, that at some point in the future, Roth withdrawals could become taxable for certain people. And so those are the risks. That second scenario seems like it might cause a riot at this point.
I tend to agree with you. I've heard people mention that as a possibility. And sure, I guess anything is possible. Like at some point, something's going to have to be done to either cut spending or raise more money in tax dollars. I think that's clear. Not a political statement, just kind of looking at the dollars and cents of where we are. That would have to, my guess is that's pretty far down the list, but it's a good point to make that it's within the realm of possibility. Probably crazier things have happened.
I should also point out like a bigger strategy, and this is for younger folks who might be earlier in their career, who are maybe have graduated from undergrad, work in an investment banking job, are making decent, good money, but plan to go back to grad school or take some type of career or earnings break. And in that case, we generally wouldn't recommend doing this strategy.
Okay.
Or in really putting everything as, do after tax, make those contributions, but maybe don't do the conversion until the year that you are underemployed or unemployed. Mm-hmm. So that not only, his tax rates are historically low, regardless of what bracket you're in right now. But if you could even lower that to 12%, 10%, depending on how much it is, that could be an even greater tax saving strategy for people who are planning some type of earnings break in the meantime, and then of course, if there are those income limits, that would be another time that you might be able to take advantage of these strategies, even if Congress does implement Roth conversion income limits, where you take a year where you're like, okay, I'm just not going to make that much money, so I can convert a bunch of my money to Roth this year. Yeah. So there are still going to be some tax planning strategies, even if that law changes.
Yeah, got it. So essentially, defer taxes when your marginal tax rate is high. And then if you're going to have a year where your marginal tax rate is low, maybe you're going back to school, maybe you're taking a sabbatical and you're going to bike across the country or something fun like that. Then pay your taxes then when you're in a low marginal tax rate. Yeah. So Kelley, I always like to ask, what are the mistakes that you see people make with this? I think you answered a couple of those, as far as, make sure that you coordinate with your tax preparer and you're not double paying this and completely destroying the benefit of what you're doing. Any other common mistakes that you see people make that they should be aware of when thinking about doing this?
I think it's mostly just not thinking through the cash flow aspect in order to make the full contribution. So it comes to end of year, it's time to make these contributions and their last paycheck isn't enough. And so just making sure that you're planning ahead for, if it's $31,500 for a lot of people who have jobs, are not going to be a paycheck, right?
Right.
It could be your bonus. And so just that's probably the biggest mistake, besides the accidentally waiting or doing those contributions throughout the year. Of course, you could go in, depending on your plan's rules, and do those conversions every 2 weeks if you're paid every 2 weeks, but that's a hassle. So if you can do a lump sum, that would limit the opportunity for error, and the error being unintentionally paying taxes on growth of those funds. So
right.
Again, it's going to be pretty plan specific, but
yeah. And I guess the other one you mentioned that's kind of just worth repeating here is just understanding that cost of illiquidity. You're talking about tying your money up for at least 5 years, possibly longer if you're younger. So just making sure that you're in a position where you're able to do that. I think a lot of people tend to kind of overlook the cost of liquidity, or the cost of illiquidity, I guess, that there's value in having liquid assets that you can convert to cash without having to pay taxes or penalties, or I guess primarily the penalties in this case. You mentioned that it varies so much by plan here, and you gave us a great list of, there's a Roth option. Do they allow after-tax contributions? Do they allow in-service withdrawals, in-plan conversions? I'm guessing a lot of people are hearing this and they're saying, wow, I have no idea. Do you recommend they just reach out to their HR professional, their HR contact, and say, "Hey, I'm thinking about doing this. Can you tell me, does our 401k offer line by line?"
Yeah, just if there's somebody in the company who's designated as the 401k or retirement benefits administrator, they're the one who's most likely going to know this. And then I should also point out, because I talked about the downside being, once you've converted those dollars and they become locked into 401k early withdrawal rules, once you've left that role, then you can roll your money into a Roth IRA, and then it becomes, again, your capital, your principal contributions are withdrawable early. So for people who are on the fire path, trying to retire early and packing money away in every way, they love the Roth savings bucket because they know they could get at their contributions early without penalty or taxes. And so this does enable that once you've left your role or the company. The other most important thing then would just be you track your basis separately. Don't rely on your 401k administrator to track how much you put in and what the growth is, especially from a Roth perspective. But yes, to go back to your question, if you're an employee benefits person, if you work for a smaller company, they may not know, then the 401k company themselves, should know. There should be a rep or a number to call, depending on who's administering the plan.
Got it. Perfect. And we'll have a list in the show notes of these kind of criteria that you ran through. So if someone really wants to, they can just kind of copy and paste that and fire it off here. Kelley, this has been super informative. Is there anything I haven't asked about the Mega Backdoor Roth that you think people should know about? Or any closing thoughts?
I think we've covered pretty much all of the nuances. I would say I did write an article about this in the Journal of Accountancy as well that lays this out as well. If that might be just as simple to reference for the criteria. And I would say if your plan has after-tax contributions but does not allow in-plan conversions, that just means you may have to wait to do the conversion until you've left the company. And so you'd have, obviously your career plans would come into play there, but that would be, and of course there would be tax consequences, because I wouldn't necessarily not invest the money in order to not have it grow for some distant date to convert tax-free. But that is, it's still worth considering, at least as an extra bucket to put away for tax deferred, at least savings and investing.
Great point. And I'm glad you mentioned that article. It's a great article that goes through all of this in detail as well. We'll make sure that is in the show notes as well. Kelley, last question for you. For folks who want to reach out to you, learn more about you, where can they find you?
Well, thanks for asking. I'm all over Instagram at Financial Bliss Coach, or my website's financialblisscoach.com. And then I have a solo podcast where I talk about money psychology, and that's called Financial Bliss with Kelley Long. So that's on all the major platforms if anybody wants to hear about money mindset stuff.
Yeah, that's great. That is a fascinating topic. It's a great podcast. Everyone should check it out. Kelley, thanks so much. This has been incredibly informative and really helpful. And I think you probably made some money for our listeners today.
My pleasure, Michael. Thanks for having me.